Do you know how your credit score stacks up against your peers? Most people don't, and the truth might surprise you. In this Money Smart Basics video, we'll break down average credit scores by age and generation, reveal where you stand, and show you simple ways to raise your score fast. Let's find out if you're ahead or falling behind. Remember to like and subscribe for more Money Smart Basics videos. If you have any suggestions for financial literacy topics, please leave a comment. Stay until the end to receive a bonus tip. When lenders look at you, they see a number. A three-digit number that sums up your financial habits. Your credit score. This number isn't just a random figure. It's a reflection of your entire financial journey, capturing how you've handled money over the years. This score is a powerful tool for banks, credit card companies, and landlords to predict how likely you are to repay borrowed money. It's their way of quickly assessing risk, helping them decide whether to trust you with a loan, a credit card, or even a place to live. A high score opens doors to better rates and more opportunities. A low score can make life more expensive. With a strong score, you might qualify for lower interest rates, saving you hundreds or even thousands of dollars over time. On the other hand, a low score can mean higher costs, stricter terms, or even outright rejection. Think of it as your financial report card, grading your history of managing debt. Just like in school, your performance is tracked and measured, and the results can follow you for years. Did you pay bills on time? Every on-time payment adds a positive mark to your record, while missed or late payments can drag your score down. Carry a lot of debt? High balances on your credit cards or loans can signal risk to lenders, even if you're making payments. Your credit score answers these questions. It's a snapshot of your financial reliability, showing lenders how you've handled credit in the past. It's a summary of your relationship with money, condensed into a single figure. This number can influence not just loans, but also things like insurance rates and even job applications in some industries. Many people find this number mysterious, but it's something you can understand and improve. The rules behind it are clear, and with the right steps you can take control of your score. Your credit score affects major life decisions like getting a mortgage or a car loan. It can determine whether you get the keys to your dream home or drive away in a new car. Even a few points can mean the difference between approval and denial, or save you thousands in interest. Lenders often have strict cutoffs, so every point counts. It follows you, influencing your financial world in ways you might not realize. Your score can impact your ability to rent an apartment, set up utilities, or even get a cell phone plan. Comparing your score to others gives you context. Are you ahead or behind for your age? It's a way to see where you stand and set realistic goals for improvement. Knowing the average scores for your peers can motivate you to improve or affirm you're on the right track. It's not about being perfect, but about making progress and celebrating small wins. This isn't about competition, it's about awareness. Understanding your score helps you make informed decisions and avoid costly mistakes. Use this information to make smarter choices. Set goals, track your progress, and take steps to build a healthier financial future. Build a stronger financial future for yourself and your family. Good credit can open doors not just for you, but for those you care about, setting an example for the next generation. Understanding your credit score is the first step to taking control of your financial health. Start today. Learn what affects your score, monitor it regularly, and make choices that move you closer to your goals. Let's take a closer look at the numbers and see how credit scores change as we move through different stages of life. In the United States, credit scores typically range from 300 to 850. The higher your score, the better your access to loans, credit cards, and favorable interest rates. National averages by age reveal how creditworthiness develops over time, reflecting both financial habits and life experiences. For example, Gen Z, those aged 18 to 26, have an average credit score of about 680. This is considered fair, and it's just the starting point for most young adults as they begin building their financial history. Millennials, who are between 27 and 42 years old, average around 705. This is a good score, reflecting a decade or more of credit experience, including student loans, car payments, and perhaps their first mortgages. Gen X, ages 43 to 58, see their average score rise to 729. This is solidly in the good range, bordering on very good, as they've managed credit for many years and often have a mix of loans and credit cards. Baby boomers, now between 59 and 77, have an average credit score of 760. This very good score reflects decades of responsible credit use, timely payments, and a long credit history. Younger adults tend to have smaller financial footprints and shorter credit histories, so their scores naturally start lower. They're just beginning to establish their credit and learn how to manage it. As people age, they build longer credit histories, take on more types of credit, and develop more diverse credit profiles, all of which help boost their scores over time. Older generations have often managed multiple loans, mortgages, and credit cards, making on-time payments and paying off debts, which significantly increases their credit scores. These trends aren't about being better or worse. They simply reflect the impact of time, experience, and financial choices on credit scores. Knowing where you stand compared to national averages can help you set realistic goals and track your progress as you build your credit. Remember, your score will likely rise as you gain more experience, make on-time payments, and manage your credit responsibly. Use these averages as a helpful benchmark to guide your journey. But remember, they're not a finish line. Your financial story is unique and you have the power to shape it. Younger people often have lower credit scores, and this can be confusing or even discouraging when you're just starting out on your financial journey. But it's not necessarily because of poor financial habits or reckless spending. It's mostly about having a limited credit history, which is something you can't control when you're just beginning. The length of your credit history is a key factor, making up about 15% of your overall credit score. The longer your history, the more data lenders have to assess your reliability. If you're in your early 20s, your credit history might only be a few years old. This is often called having a thin file, and it means there's just not much information for credit scoring models to work with. Lenders prefer to see a long, consistent track record of responsible borrowing and repayment, which takes years to build up. Without much data, scoring models can't confidently give you a high score yet, even if you've never missed a payment. Another important factor is your credit mix, which accounts for about 10% of your score. This means having different types of credit, like credit cards, auto loans, or a mortgage. Most young adults only have student loans or maybe a single credit card, so their credit mix is limited. This lack of variety can make it harder to boost your score. Compared to older borrowers who may have mortgages, car loans, and multiple credit cards, young people's limited credit options can hold their scores back. On top of that, lower incomes and frequent life changes, like moving for school or starting a new job, can lead to financial missteps or missed payments. For someone with a short credit history, even one late payment can have a much bigger impact on their score than it would for someone with a long established record. If you've only had credit for 2 years, a single late payment can drag your score down significantly, making it harder to qualify for loans or get good interest rates. But for someone with a 20-year credit history, that same late payment is just a minor blemish, barely making a dent in their overall score. Ultimately, time and experience are the biggest hurdles for young credit profiles. Building a strong credit history takes patience, but with responsible habits, your score will grow as you do. Older generations benefit from time, decades to build a detailed credit history. A long record of on-time payments outweighs old mistakes, which fade over time. More accounts mean more positive data, insulating scores from minor slip-ups. By their 50s or 60s, most people have managed various types of credit, cards, mortgages, auto loans. This diversity shows lenders they can handle different obligations. Older adults often have lower credit utilization, using less of their available credit. High limits and low balances signal financial stability. All these factors combine to boost scores for older generations. Time, diversity, and low utilization are their biggest advantages. To improve your credit score, know what goes into it. 5 main factors shape your score. Payment history is most important, 35%. Pay bills on time, every time. Even one late payment can hurt, especially if it's over 30 days late. Credit utilization is next, 30%. It's about the percentage of your available credit you're using. Keep utilization below 30% for a healthy score. Length of credit history counts for 15%. New credit, 10%, looks at how many new accounts you've opened recently. Too many new accounts can signal risk. Credit mix, 10%, rewards having both revolving credit cards and installment loans. Master these basics to build a strong score. Credit utilization is one of the fastest ways to impact your score. It's the ratio of your credit card balances to your limits. High utilization signals risk. Maxed out cards hurt your score. Two people with $5,000 in debt can have very different scores if one has a $5,000 limit, 100% utilization, and the other has $25,000, 20% utilization. Keep overall utilization below 30% and ideally under 10% for top scores. Lenders look at both overall and individual card utilization, spread balances out if needed, pay down balances or ask for a credit limit increase to improve your ratio. Most issuers report monthly, so positive changes can show up quickly. You have direct control over this factor, use it to your advantage. Building credit doesn't have to be complicated. Pay every bill on time, credit cards, loans, utilities, and rent. Set up automatic payments to avoid missed due dates. If you have no credit history, start with a secured credit card. Make small purchases and pay in full each month. After a year of good behavior, you may qualify for an unsecured card. Become an authorized user on a family member's card with good habits to boost your score. Start small 1 or 2 cards, manageable purchases, paid off monthly. The goal isn't to carry debt, but to show responsible use. Be patient. Credit building is a marathon, not a sprint. Consistent positive habits lay the foundation for your financial future. Every on-time payment moves you forward. Ready to push your score higher? Try these advanced tips. Pay off most of your balance before your statement closes to report low utilization. Diversify your credit mix. Add a small installment loan if you only have credit cards. Credit builder loans from credit unions can help. Don't close old credit card accounts. Keeping them open maintains your average account age and available credit. Use old cards occasionally to keep them active. Regularly check your credit reports for errors. Get free reports from all 3 bureaus at annualcreditreport.com. Dispute any mistakes you find. Correcting errors can quickly boost your score. These strategies, combined with the basics, can help you reach excellent credit. Stay proactive and monitor your progress. Small tweaks can make a big difference. Your credit score is more than a number, it's your financial reputation. Scores differ by age because building credit takes time and experience. Younger people start with a blank slate. Older generations benefit from years of good habits. The path to a better score is simple. Pay bills on time and keep balances low. These 2 actions make up most of your score. Don't worry if your score isn't perfect. Everyone starts somewhere. Use tools like secured cards, authorized user status, and regular credit report checks. Each positive step builds your future. Knowledge is your first step. Check your score and review your report. Many banks offer free access to your score. Don't fear the number. Use it as a map for improvement. Your financial future is in your hands. Start today, take control, and drive your own success. Congratulations, you made it to the end of the video. With that, you are ahead of 90% of most people in America. Here is the bonus tip that we promised. Don't just compare your credit score, focus on improving it. One of the fastest ways to boost your score is by keeping your credit utilization under 30%. For example, if your credit limit is $1,000, try not to use more than $300. This shows lenders you can manage credit responsibly and helps raise your score over time. The information provided in this content is for educational and informational purposes only and should not be considered financial, legal, or tax advice. Always consult with a qualified financial advisor, tax professional, or legal counsel before making any financial decisions. The creator of this content is not responsible for any actions taken based on the information provided. Investments and financial decisions carry risk, and past performance does not guarantee future results.